Hello and good morning to everyone. I'm super excited to have you present in this webinar. My name is Jalaj and I'm the moderator for this session. So the subject of our webinar today is ESOP resolutions, dissecting proxy firms' view. See, we know that proxy firms play a very important role in the approving of resolutions, major resolutions by the company board. They look upon the shareholders' interest, their long-term interest, and that is the reason why the ESOP resolutions are also being scanned to the minutest detail. So in this session, we expect the value, to you in terms of what is the perception of the proxy firms and how we can constructively engage them in explaining our point of view. At the end of the day, they are also looking after ESOP resolutions from the corporate governance and from the fairness perspective. In the presentation, we have also covered the analysis of the resolutions, which proxy firms, what opinions they have given. So that is the data point which will help us. Let me welcome the speaker for this session. Let us all welcome Harshu here. Harshu is co-founder and managing director of ESOP Direct. He is going to explain his point of view on his basis his research of these resolutions. The rules are very clear here. Will not have Q&A during the session, but as we go along, at the end of the session, we'll have the question answer round. In between, if you have any questions, you can write it on the chat box. We'll take it up at the end. Over to you, Harshu. Harshu, you are on mute.
Yeah.
Yeah.
Thanks, Jalaj, and very good morning and welcome to all to this webinar. It's been our endeavor to take up topics which are contemporary and important in a given situation. And over the years, we have seen the importance of proxy firms. How do I take control here? ये यहाँ पे दिख नहीं रहा है. Just give me a minute.
Yeah, Harshu, that's fine.
How does he? Yeah. Over the years, we have seen proxy firms becoming more and more active and more sort of investigative in this part of the corporate governance. And we thought that since there is enough data available in the public domain about how these proxy firms have voted or what their opinions are. They have been very progressive in terms of even putting up their recommendations on their website, which is a public domain, and people can sort of understand what they have to say and why do they think in a particular way. So what we have done here is we have basically analyzed all the ESOP resolutions which proxy firms gave their opinion on during the last 3-4 years, and that's a good sample. We have looked at about 260 resolutions on which they have given opinions and come up with this analysis. What we also found on the way is that a lot can be achieved if there is an increasing sort of a communication or a dialogue between the companies and the proxy firms, because whatever are the respective views of the companies as well as the proxy firms, I think can be, if they are discussed and rationalized, the other person can see each other's views. So starting on the presentation, what we're going to cover is basically have a quick look at why this topic is relevant today. who are the stakeholders and where do proxy firms fit in? What is their perspective? Whom do they basically relate to? We also look at some of the finer ESOP design elements and their perspectives. So perspectives from the company's point of view and perspectives from the proxy firms point of view. Uh, there are three or four major areas where we see a divergence in opinion, and we have sort of analyzed them further. We have also looked at the data, as I said, about 260 resolutions, looking at how proxy firms could have thought about while they gave their opinion on. And we have also finally looked at, how can these friction points be addressed in terms of, coming to a common ground. Lastly, we have also looked at global practices, and I think investor activism that we see becoming more and more dominant in the last 4 or 5 years. It will be good to know how some of the proxy firms globally are looking at these resolutions, and what do they like, what do they don't like. One of the first reason, obviously, why this topic is relevant is ultimately every company would want its resolutions to be passed, and we need buy-in from every shareholder, ideally. And since institutional shareholding is on the rise, and proxy firms represent these investors, it is important to get their buy-in. Uh, Increasingly, more and more companies, and since ESOP resolutions are special resolutions, you need a 75% voting in favor. So, especially companies where institutional holding is quite high, this can become very critical. We all know as practicing managers, any rejection of a resolution is quite embarrassing. I mean, apart from the negative press, it also delays the whole process, and the uncertainty about the launch of ESOP can also, increase. Rejection can also give a wrong message to employees, because ultimately employees might feel that it is being rejected because it was unfair. So this is clearly avoidable. While we were analyzing the way proxy firms have voted, we figured out that ESOP is incidentally the largest single area where proxy firms have given an adverse vote. And actually, one of the firms has rejected 75% of the ESOP resolutions it has opined on, which is quite alarming. And that's where we thought that it is important to sort of create some awareness about this. What we also find while executing our assignments and interactions with the companies is the views of proxy firms are not part of ESOP design discussions that happen either at the management level or even at the board level. I think increasingly this is becoming very critical, and I think they are a major stakeholder that companies need to take note of. Um, as I mentioned about increasing investor activism. So as the institutional holding goes up, and especially not only overseas institutional investors, but also local investors, they are seeking professional advice in terms of how do they evaluate resolutions and how do they vote. So in view of all these 5, 6 reasons, we thought that this topic is worth a discussion. If you look at the stakeholders, we have regulators on one side, SEBI, Stock Exchange, RBI, company law. You have investors, basically institutional, the shareholders. Then we have the board of directors, and this includes the company management, the NRC, and the basically putting across the company's viewpoint. And finally, of course, the employees who are the major beneficiaries of this instrument. So if you were to figure out as to where do proxy firms fit in, so obviously they are sort of representing the investors. And as a representative of the investors, essentially what they are looking at is, do these plans create a long-term value, both for the employees as well as for the shareholders? So anything in the plan which is of a short-term nature is something that they may not favorably look at. They are also looking at distribution of the grants. So, whether the plans are broad-based, whether you are only giving it to select few people, the quantum of the grant and so on. And one again, a very important parameter in their evaluation is whether the plans are linked to performance. So basically, whether the vesting is linked to some performance conditions. What we have noticed is um the proxy firms are presuming legal compliance. So we haven't seen any comment on whether a particular resolution is legal or not legal, whether it is complying with SEBI regulations or not. We haven't seen any comments, so presumably they are taking compliance as a given. And what we also see in terms of their comments is they usually dislike discretion, which could be, in their opinion, which could be, which has a potential to be misused. So at a very high level, this is how proxy firms look at it, and we are, as we go forward, we are going to analyze this further. There are quite a few uh, considerations which go into when the companies are planning on their ESOP design, and these are just a few of them. And the reason why we selected these six is because they are not normally debated much, and also, but the proxy firms have very strong views on these. So coming to the first one from the top, loan to the trust. So the way companies look at it is, we have all seen this in our surveys also, that the use of trust is on the rise. Many companies are using the trust route, and irrespective of whether they are using secondary shares or primary shares. And since trust does not have any source of funds of its own, loan from the company is imperative. So that is a very much a part of the structure of any ESOP through the trust route. However, if you look at how proxy firms have looked at it, so amongst the resolutions which had a loan provision for the trust and secondary shares, 86% were voted against. Which means that the proxy firms have a very clear dislike if the company is funding the secondary purchase and also secondary shares. So at the same time, if the resolution said that we would give a loan to the trust and we would use both the sources, which is primary and secondary, only 30% were voted against. And if it is primary shares and a loan, 27% were voted against. So there is some reservation that firms have on funding of the trust by the company. In terms of the source of shares, as I said, secondary shares, companies normally prefer it because they are anti-dilutive. There is no change in the shareholding. There is no dilution for promoters. There is no dilution for existing shareholders, and which works to the advantage of the shareholders. However, what we see in the analysis is, wherever companies have proposed secondary shares, 90% have got a negative vote. Which is a bit surprising. I think this is where I mentioned about a dialogue, communication between the companies and the proxy firms to understand each other's views and, basically convince each other on this. At the same time, what we also saw is wherever companies have been slightly vague about source of shares, whether, either they are not sure about whether it is going to be primary or secondary, and they have mentioned that they may use both the sources, only 30% have got, a negative vote, which is also a indication on, how the resolutions could be worded. Vesting conditions is a very important subject, and we see that a lot of prominence given to this in the commentary of proxy firms. So they obviously want performance conditions to be defined as much as possible. However, the company viewpoint is that since ESOPs is a long-term instrument, 4, 5, 7 year instrument, and it is not possible, especially in the given dynamic business environment, to define a performance condition over that longer period. I mean, companies are changing their business models every 2, 3 years, and it's not practical to define performance conditions. Our experience with performance conditions, companies having performance conditions also shows that a large number of these options where performance is defined actually get lapsed because companies' business plans change, and the economy changes, economic environment changes, and those goals are no longer relevant. So I think it is very practical not to hard code performance conditions in the resolution. Obviously, when the grants are made or when evaluations are done, they are hard coded, but cannot be practically done, defined in a resolution. The second logic of companies is, especially at a junior level where you are granting, the junior staff cannot actually relate themselves or their performance to the company performance, and which could be at a divergence. So it is very difficult to define a 30% growth in EBITDA or sales top line, etc. For a junior person who may not be able to relate there. What we see as expectations of the proxy firms is that they need clear disclosures and less discretion. Very clear linkage to performance, as we will see later. They have a very strong inclination towards resolutions having performance conditions as a and they have also not been very kind to resolutions where the board or the NRC has been given discretion to define these conditions later. This is one topic that we'll discuss later, but I think this is a very important consideration where both companies and the proxy firms have to come on the same page. Coming to the instrument, which is again a very important factor. Of late, we have seen in the last 5, 6 years, more and more companies going for instruments other than ESOPs. So RSUs is one of them. Stock appreciation rights is another. So companies have been looking at RSUs mainly from a viewpoint that it reduces dilution. As companies grant more and more equity, their appetite to dilute more goes down, and companies look at all ways to basically curtail dilution, and RSUs is a good way to address that. In some cases, it's also possible that with the Ind AS coming into picture, it is possible to reduce the accounting charge under the fair value method if one is were to grant RSUs, and that is also one more reason why companies are preferring RSUs. However, the proxy firm seems to have a very clear, reservation against use of RSUs, and the basic, apprehension there is, why should you give something free to employees? Free, I mean, RSUs are typically at face value, so why should you give something almost free to employees when the investors are taking, a much bigger risk? So among all the resolutions, we see a very clear preference for ESOPs, which are granted at market value. I think proxy firms here are clearly looking at only the price element of the instrument and not necessarily other advantages which are actually in the interest of the shareholders as well. So it will be good, again, a good area where proxy firms need to be engaged. I mentioned about proxy firms not liking too much of concentration of grant in a select few employees. However, the company's viewpoint there is it is important that if ESOPs were to be used as a deterrent in order to retain good talent, it is important that the grants are higher and the value is much higher than the cash compensation. Our surveys also show that senior management gets almost like more than 70% of the grants that are made to employees, which is a clear indication of what the companies are looking at. Um, Globally, also the practice is to grant more options to fewer people. Of course, in the US, there are other instruments and other plans which companies have, what is called as a stock purchase plan, where these are broad-based and company-wide plans. But when it comes to options, the global practice is to grant to very few people and grant significantly high quantums. Uh, and obviously, the proxy firms do not seem to sort of agree to that, and they have been very vocal about this. The final critical element of design is the accounting cost. Uh, Obviously, as I said, with Ind AS becoming effective, whether you issue options at market value or at discounts, I mean, every option has a cost and it has to be expensed. However, companies feel that it's a non-cash cost, so there is no liability, though it's a hit to P&L. It reduces EPS, but there is no payout. It actually goes back to the reserves. So that's the reasoning which companies have, and more importantly, of late we have seen the tax credits which the companies get on the options is significantly higher, and I think this is a topic in itself as to how tax credits are actually adding significantly to the ROI of this instrument. And this is one element which we feel is not very adequately presented before the proxy firms in terms of the cost which companies take in their books. Proxy firms are obviously not uh, accepting this notional cost rationale, and I mean, at least we have not come across any assessment which shows that they have also looked at the ROI of the instrument. I think from a shareholder's point of view, this is something which is very important, because anything which is non-cash and with a high ROI makes a lot of sense for shareholders. And I think this again is a topic where more interactions with proxy firms will help. So these are the top six reasons, design elements that we feel, apart from some other factors which will come to later. But here we see quite a divergence in the way companies or the board is looking at, these particular features, and the way proxy firms are evaluating it. And I think as we go forward, I mean, I'll re-emphasize on the need for a closer communication between the two. There are some other friction points which came out very clearly in the way proxy firms have opined on their comments. One obviously is the pricing. We have talked about it in terms of instrument. So the proxy firm's view in terms of discount is, if you give discount, it is diluting shareholders' value. And while the discount provides a safety net to employees, it is not available to shareholders. So basically, employees don't have a skin in the game. And since the proxy firms feel that ESOPs is an instrument meant only for people who understand it, so they feel that they need to have skin in the game. Company perspective is discount ensures lower dilution, because if you give options with high intrinsic value, you may need less number of options. And also the feeling is that employees are not equipped to take the market risk, which financial investors are by their very nature, they have a higher risk appetite. So there is a clear distinction in the way two stakeholders look at it. The second aspect is about dilution. Again, proxy firms feel that higher dilution reduces the ability to raise capital later on, and it also leads to lowering shareholder value. However, as is done globally, and I think the global proxy firms also recognize this, that what is important to see is not the dilution which is mentioned in the resolutions, but basically to look at options overhang, which is what is the percentage of outstanding options to the paid up capital. And invariably, this is very, very low because options which are exercised and basically form part of, I mean, if employees have already become shareholders, um, that is no longer a additional dilution. So the better metrics to track and which is tracked globally is the options overhang and not dilution. We talked about this coverage and concentration of grants. We saw in some of these commentaries that proxy firms have given, and also during our interactions on behalf of our clients, that many times proxy firms feel that um, if there are high amounts at stake, especially when your grants to say at a CXO level is very high, it is likely to influence management actions towards short-term benefits. Whereas investors, especially institutional investors, are looking at long-term value creation. So this could work against the interest of the shareholders. That is the view proxy firms have. I mean, off and on, we have seen cases, instances where this has happened, where some of the decisions, some of the financial decisions are taken by the senior management have resulted into short-term benefits, but a long-term value loss. But I mean, it's a matter of debate whether this is something which can be generalized. But that is the view proxy firms have. They also feel that if the objective is wealth creation, it should be more broad-based, because then it will be, in the better interest of the organization. If if the plans are more employee friendly and basically you are covering more and more employees. So that is the perspective of the proxy firms. However, to the company's thought process, and we have also seen this working, is employees at lower levels are preferring cash, and because they do not understand, basically they do not understand long-term aspect of ESOPs, and they also feel that it's slightly more complicated to understand. And as I said earlier, employees at lower levels find it difficult to relate their performance to the company performance. And yeah, they need a segregation where they feel that if I have worked hard, I need to get my incentives. I have little control on how the company is doing. So that feeling is more prominent at lower levels, and that creates a barrier to basically make these plans broad-based. Similarly, companies also feel that if the objective is to retain talent, the options, the grants have to be significantly high to really act as a deterrent. One of the aspects that we have seen in the comments, where especially, proxy firms have disliked, is the clarity in the resolutions. Um, the proxy firms need more and more clarity in, what the companies are actually going to do in terms of their option grants. And this has, I mean, as the analysis, will show again, that wherever there has been a discretion given either to the board or to the NRC to decide on any aspect of these plans, it has not found favor of the proxy firms. To the company's point, as I said, in a dynamic situation, business environment, it is difficult to hard code everything in a resolution. And again, this is something which uh, the companies will have to reason it out with the investors, with the proxy firms as they discuss their resolutions. So I think these are the four friction points, the top four friction points that we see, and we have also looked at the data of these resolutions that we see. Going, we'll see that in going forward. So this is basically we have looked at 260 resolutions, and the source of this is all the reports which have been shared by the proxy firms on their website. So this is completely information available in the public domain, and we have analyzed them. So if you look at, I mean, a quick snapshot in terms of, and this is the data from 17-18, so last 4 years data. Overall, and these are the two proxy firms that are well known, IIAS and SES. I'm sure there are, some of you may have dealt with a couple of others, but these are the more prominent ones. And within the two, as you can see, IIAS has given about 256 opinions, whereas SES has given close to 200 opinions and on different instruments. So the way to look at it would be that out of 188 ESOP resolutions, um, 72 have been, recommended a negative vote by IIS, whereas a whopping 107 have been recommended a negative vote by SES. So this is a very big indicator to show that proxy firms have not been very kind to these resolutions. And if you go down RSUs, which is the next more popular instrument, out of 39 RSU resolutions, IIS has rejected 27 of them, which is again a very significantly high percentage. So this goes to show that uh, across instruments there is a lot more that can be done to sort of get favor of the proxy firms. If you look at the data of the last 4 years in terms of how many opinions or how many resolutions came up, and this we have looked at only IIS data because clubbing both the firms would have made the analysis difficult. So we have looked at IIS data, which is like 256 resolutions over the last 4 years. And if you see, barring a exception in 2021, which was a COVID year, and almost like 70% of the resolutions were approved by IIS, by and large, it's been more like a 50-50, where one out of every two resolutions have been rejected by IIS over the last 4 years. While looking at this data, I think it is important to know this, that the recommendations, for example, when we say IIS has rejected 72 out of 188 resolutions, this rejection may not be on count of one particular aspect. Like it may not be just because it is an RSU, or it may not be just because the dilution is very high. It could the final recommendation of the firms can be a combination of several factors. Uh, However, in order to make the analysis simpler, we have looked at each parameter, separately. So this may not directly show the voting preferences or why they arrived at a particular opinion, but it can show us the trend. It can show us the way proxy firms are thinking. So as I said, we have analyzed these resolutions on these four parameters: instrument, pricing, dilution, and vesting conditions. Now, this is a voting pattern when it comes to these three parameters: dilution, pricing, and voting vesting conditions. Basically, uh, and this is an analysis of 188 resolutions for ESOPs. which by far is the largest, most commonly used instrument. So when you look at the dilution, we have looked at three parameters. So wherever dilution is less than 2%, it is between 2 to 5%, or if the dilution is more than 5%. So similarly, when it comes to pricing, we have looked at discount to market price, whether it is a face value grant or whether it is a market value grant, or whether companies have kept the pricing open-ended to be decided by the board, as and when grants are made. So these are the four categories on which we have looked at pricing. When it comes to vesting conditions, we have looked at whether resolutions say that it will be a mix of performance and time-based, or whether it will be only performance-based, or whether it will be, and some cases they have not even disclosed. So, looking at the proxy firms, reservations, we have, if you look at, typically, if we say that proxy firms don't like more dilution. So, wherever there have been more than 5% dilution requests to shareholders, what we see is close to 60% of the resolutions have still got a favorable, not vote from the proxy firms, even though the dilution is more than 5%. Similarly, these are, I mean, if you look at less than 2%, it is 62. So about 38% of the resolution still got rejected by proxy firms, even though the dilution was less than 2%. Which is quite, obviously, as I said, there could be some other combination of factors which could have made, proxy firms think other way. But it is not that just because you are asking for more than 5% dilution, proxy firms would reject it. They have approved, more than half of the resolutions which did recommend more than 5% dilution. Similarly, if you look at discount to market price, it's not that blanket disapproval. If other factors are favorable, proxy firms have looked at, for example, got a favorable nod from the proxy firms. Whereas if you see open-ended, it is still 40% which have got not, but 60% have got rejected because the pricing was kept open-ended. So this is very clearly something that proxy firms are not liking. Similarly, about vesting conditions, if you see, if other things are in place, proxy firms have approved 60% of the resolutions, which did not disclose the vesting conditions in greater detail. So I think it is, one cannot pinpoint a single particular factor, so there could be other reasons why they have done this. But this is useful to give some trends in the way they are thinking. If we look at it the other way around, I mean, if you look at it that uh, out of 188 resolutions that we saw, I mean, proxy firms have rejected 72 of them. And if we were to analyze what was the reason for those 72, resolutions being rejected. So what we find here is 68 out of those 72 did not disclose specific vesting conditions. So this looks like a very prominent reason why companies have why proxy firms have rejected resolutions. Similarly, 50 of them had left the pricing to open-ended to be decided by the board, which again proxy firms don't seem to be liking. So these are 2-3 good indicators to show that if you are looking for a favorable vote from the proxy firms, I think it will be important to at least spell out in some detail, if not everything, in some detail to disclose about pricing and also about vesting conditions. Obviously, I mean, it's also required under the law. SEBI regulations require that pricing or the pricing mechanism, the pricing formula has to be disclosed in the resolution. So keeping it open-ended is as it is on the borderline of making the resolution slightly open to some questioning. Similarly, if you look at RSUs, 27 resolutions out of 39 were rejected by IIS. And when we went down to the reasons why they have been rejected, so even though 23 out of them had a 2%, less than 2% dilution. So as I said, RSUs are used by companies where they need less number of shares. So they could do with 2% dilution, less than 2% dilution, but still IIS has rejected them. Obviously, being RSUs, all of them were at face value, so that could be one more reason for rejection. But I think the more important reason here could be the mixed vesting conditions. So what probably they are saying is that you are giving shares free to employees, but at the same time you are not spelling out that it will be only performance based. You are still keeping it vague by saying that you will have a mix of vesting, performance and time based. So that is some vagueness that proxy firms don't seem to be liking. Now, looking at these, friction points and how they can be addressed, and as I said, the whole objective is to bring, companies and the proxy firms on the same table, and basically ensure that more and more resolutions get approval from the proxy firm. So, if we were to look at a plan design aspects, I think whatever reservations proxy firms have with reference to their discounted price, it can be compensated by having adequate performance conditions. I think this should convince the proxy firms. Uh, how vague or how precise you can be will be dependent on each company, but it will be good to go to that route. Um and I think as we have seen, the dilution reservation will also go down if you were to give some discounts. In terms of broad-based, plans which proxy firms want, I think it will be good if companies could look at separate plans for senior management and other employees. For example, you could look at a option structure for senior management, whereas you could look at a stock purchase plan for junior level, broad-based plans. Obviously, each plan will have its own design elements, and proxy firms will find it easier to sort of analyze those. The anomaly that we saw in terms of way secondary shares are being viewed by the proxy firms, I think it can be addressed. I think the business case for using secondary shares need to be presented much more actively and aggressively by the companies. I think it makes a lot of sense for shareholders to use secondary shares, and even the loan to the trust. I mean, ultimately, it's not a permanent loan or anything. I mean, it's a question of matter of time before the trust usually repays. And if you look at all the trust, I mean, at least in our experience, we have seen that all the trusts which are implementing stock options after a 3 or 4 year period, they are all cash surplus, and all the loans to the companies are repaid within that period. So it's not I think proxy firms need to be told that it's not siphoning of cash, or even the recent restrictions that have come into the SEBI regulations with respect to the trust operations have plugged all the loopholes which were there in terms of diverting company funds for purchasing shares. I think what also needs to be articulated much better by the companies is ESOPs is not just about dilution and pricing. It is much beyond that. And ESOPs have a very strong compensation element. So it is important that, I mean, obviously, as a shareholder also, they need to look at ESOPs beyond, just dilution and pricing. I think this needs to be better articulated with the proxy firms. I already mentioned about tax credits which companies get these have not been properly highlighted. I'm sure every company is taking all the advantage which is provided in terms of tax advantage with the recent case laws and the regulations. And if the ROI is explained to the proxy firms, I'm sure their view of this instrument will be different. We also feel that proxy firms also need to make themselves more aware about the business expectations and how companies have used it. Also about some of the ways ESOPs have helped companies either in terms of retention of talent or attracting talent, and also in terms of wealth sharing. I think over the last 8-10 years, we have had enough case law case studies to show how this instrument has worked to the benefit of everyone. Globally, there are surveys made. We have not tried that in India yet, but globally, there are surveys made which showed that companies which had equity compensation as a part of their strategy have performed much better than companies who did not have it. So some statistics like this needs to be presented to the proxy firms, and they also need to appreciate that. What we have seen from our experience is if companies are proactive in terms of interacting with the proxy firms and the key institutional investors to seek their buy-in, I think better it will be instead of taking their vote for granted. We have seen that wherever companies have done this proactively, it has helped. And our interactions with the proxy firms have also been where they have been quite appreciative of the company's viewpoint, and they have also been very transparent as to what their reservations are. We have also seen cases where they have given suggestions to the companies as to if you tweak this term or this clause in a particular way, they would look at it differently. So these interactions do help, and I think it will be good for companies to do this proactively. And obviously, the best way to do is either convince or get convinced in order to be on the same page. Last slide, I'm coming on the global best practices in this. So if we were to look at US and Europe as regions to basically look at, ISS and Glass Lewis are the two prominent firms which are providing this advice to the institutional shareholders. I mean, if one were to just go to their website, I mean, the kind of data that they have published in terms of what their guidelines are and how they evaluate these resolutions. They have also come out with a country-specific advisory. For example, both of them have advisory specific to Indian companies. So if any of their clients have invested in India, and if they were to give opinions, they have given a guideline, published a guideline which says that, okay, if Indian companies were to follow these norms, we would vote for it. So quite a exhaustive, guidelines and very good indication of, how these companies are thinking. SEC has also made it mandatory for proxy firms to give 48 hours to companies to respond to their observations. So it doesn't come as a surprise to companies. I'm not aware whether something similar is there in SEBI. To my knowledge, there is nothing like this which has SEBI has said. So I think it is completely left to the companies and the proxy firms to discuss. This is more voluntary rather than mandatory. We just looked at the US guidelines which ISS has published, and they have a very interesting concept called as a equity plan scorecard. So basically, they have published a scorecard as to how they are going to evaluate resolutions, and companies can do their own evaluation. So companies can fill up their own scorecard and figure out whether this will pass ISS or not. Very interesting concept, and I think something which should be implemented in India. Completely transparent, so companies know beforehand whether proxy firms are going to approve it or not. Second interesting concept they have is they calculate the cost of the plan. So basically, how much is it going to cost in terms of charge to P&L, and what they call as a shareholder value transfer. And this also includes the cost of dilution. So this is something that they track, and they have a very strong preference to sort of compare whatever they are looking at for a company, they compare it with the peers. So if you were to say that, okay, we are going to dilute 5%, they would compare it with peers and figure out how much have, somebody similar has diluted and so on. Very interestingly, they encourage the use of secondary shares. Obviously, the cost of purchasing these shares, I mean, in the US, it's, you have this concept of treasury stock, so companies can buy their own shares. So the cost of purchase is included as a part of the SVT, so it's taken as a cost of the plan. But they have been encouraging because, as I said, secondary shares are anti-dilutive. They also seek a lot of information from companies on compensation policies, equity compensation policies, peer group companies, pay for performance policies, TSR information. TSR is a total shareholder return. How much have the companies earned in terms of the total shareholder return. So this is something that they ask from companies and also, consider it while giving their opinions. Glass Lewis again has country specific guidelines. If you look at their US guidelines, they also encourage use of secondary shares. Interestingly, they say that if the plan is providing for repricing, they tend to reject that plan. So a very interesting consideration. So there again, basically they are saying that don't board should not have a discretion to reprice. You come back to shareholders if you were to reprice. In terms of performance conditions, they prefer if companies give more than two performance metrics to be monitored. They also, are realistic to say that performance conditions should not be too stringent to provoke, fraudulent behavior. The risk that we, spoke about where the behavior or the actions could be to short-term advantage and which may not be in the right spirit. They've also looked at, they encourage the double trigger in the change in control arrangements. So basically, this is about accelerated vesting, where whenever there is a change in control, unless there is a double trigger, which means that there is a change in control as well as there is a termination of the employment. These clauses don't accelerated vesting don't trigger. So some of these clauses are very, interesting that we found, and something which even Indian proxy firms could evaluate. That's it I had from my side. I think we have about 7-8 minutes for questions, so I'll be glad to take questions. Jalaj, over to you. So the final takeaways I have, just to re-emphasize, the role of proxy firms is here to stay. Engaging them is essential. All of us know that corporate governance standards require more and more disclosures, and it will be the interest of the companies also to do that. And more importantly, proxy firms are willing to listen and get convinced. So that's it from me. Jalaj, over to you.
Yeah, thank you, Harshu. And I can see that this was very exhaustive. In the way you have covered this, we are well within time. So let me ask you some questions which have come from the audience side, and I will also add my perspectives to it. So one of the questions which has come up is from a engagement standpoint, and you have covered it in your slide. But let me ask you from your experience, how do you see companies can actually get into a constructive engagement, given that it might not be possible to define each and every point in their shareholders resolution. So in such a context, how can company convince the proxy firms from a engagement standpoint? How does it happen? I mean, is it before the notices are sent to the shareholders, or after it is sent? I mean, if you can share your experience on that, it will be really good.
Yeah, so as I said, perspectives, as we saw, perspectives are quite different on many points. And I think while companies are looking at it beyond, beyond, as I said, beyond just dilution and pricing, there is a strong element of compensation or the employee side of it, which I think needs to be properly, presented and, highlighted in front of the proxy firms. Um, and I think if they are convinced that whatever companies are doing is in the interest of the shareholders and it is not against their interest, I think proxy firms should be willing to listen. Uh, I think our experience with the companies and the proxy firms, wherever we have interacted with the proxy firms on behalf of the companies, shows that they are willing to listen. I mean, they are willing to hear the rationale. For example, we saw that in 2021, more than 70% of the resolutions were passed by proxy firms. And if you see most of these companies who went for ESOP resolutions in this period, they were quite liberal in terms of pricing or vesting conditions.
Yeah.
So basically, that was to address the grievance or the difficulties which employees were facing.
Yeah.
And proxy firms did take a sympathetic, look for it. They did approve it, knowing the business conditions and the business, emergencies. So I think it is. I'm sure every company is trying it, but I think it is important to be proactive in this, reaching out to the proxy firms.
Okay. Ashu, one more question which came to my mind, and I think I should ask you, is about underwater options. When a company facing underwater situation, and one of the avenues open to them is repricing of those options. So, what do you think in such situations, as we've seen also from a US guideline that the repricing should only go to the shareholders, should not be considered at the board level. So, from your understanding of the Indian context, how do you see proxy firms look at the repricing side of the options, especially when these are underwater?
Yeah, I think even under the Indian regulations, SEBI regulations, any repricing goes back to shareholders. So this is not something which companies can decide on their own. So obviously, every such resolution will go to the proxy firms for their evaluation. So even if companies want, they cannot reprice without shareholder approval. Uh, Again, here. If even if you were to look at it not purely from employee point of view, but also from shareholder point of view, I think what they would like to see is whether, while doing the repricing, shareholder interests are protected. For example, when you are repricing the option, you cannot keep the number of options the same and just reduce the exercise price, because that is clearly against the interests of the shareholders. So while you are giving advantage to the employee of the downturn, shareholders have actually burned their fingers. So though every employee cannot wear the hat of an investor, but I think when you look at an overall plan, it cannot be very completely one-sided where you say that we will protect employees from downside, but we will give them the whole upside.
Yeah.
Whereas shareholders only get the upside and they don't, get the downside. So, uh, it's. I will not say that proxy firms will look at very kindly for repricing, but if there is a business case made and if it is shown that basically it is not favoring the employees, if even if one way to retain the value that the options had earlier and not give more value to the employees, I think proxy firms can be convinced about it.
Okay. Ashu, one last question, which I'm just willing to ask you. This is about the point you touched, that the ROI aspect from a tax credit standpoint, and this is, as you rightly said, it's a session in itself. So, uh, can you explain it maybe in a crisp way as to what that is intended, and how the companies can be benefited because of the tax credit?
Yeah, actually, our understanding is that every company is taking a tax credit for this. So, for example, Though it is not law as of now, there is enough case law to show that whatever value on which employees are paying perquisite tax, so the perquisite value can be claimed as a deduction by the companies in their books, as and when that perquisite value is crystallized. So basically, the same point at which employee is paying perquisite tax, the company can claim a deduction of that perquisite value, which I'm sure every company is doing. But this is not being articulated when somebody is talking about a high cost of ESOPs or
Yeah,
the high accounting charge. Accounting charge is still notional, whereas tax credit is real.
yeah,
And as we speak, we are doing this analysis also. What are the ROIs companies have got over a period of time on their instruments? And I mean, whatever data we have is phenomenal. I mean,
yeah.
if this is showcased properly to the proxy firms, I'm sure they will realize the immense value. So uh, actually, the tax credit far out, is far higher than the notional cost which companies take.
That's true, Raj. I mean, I will love to have another session on that topic. We'll organize that soon as we complete the research work.
Mhm.
Thank you so much, Harshu, for your time. Thank you so much for all the participants for being such a kind audience. We will be sharing a feedback form after this session. You may give us your feedback, what you want to see further in terms of topics or also improvements which you want from these webinars. So, I mean, we can close the session now. Thank you so much. And we look forward to have you with us in another round of webinar very soon. Thank you so much.
Thank you
Thank
very
you.
much. Thank you.
Thank you. Thank you.